Well, welcome back, everyone, to our next session of the Modern Investor Summit. I'm Theodora, and I'm thrilled to kick off this fireside chat with a truly exceptional guest. Today, I'm joined by Stephanie Leung, who is the Chief Investment Officer at StashAway. Stephanie is here to share her wealth of experience and insights on how to build a winning investment portfolio, whether you're starting out with $10,000 or scaling up to larger amounts. We'll explore how to balance risk and reward, avoid common pitfalls, and take advantage of the opportunities we have today that weren't available a decade ago. Nice to have you with us, Stephanie.
Thank you so much for having me, and thank you so much.
Great. But before we begin, just a bit of housekeeping. If you haven't already, please introduce yourself in the chat box with your name and where you're tuning in from. This will be a 20-minute discussion followed by a 10-minute audience Q&A, so feel free to pop your questions in the Q&A box. All right, so let's get started. Stephanie, it's really great to have you here today. I have a first question for you. It's kind of what we talked about. First question is, what would you say is the biggest advantage for an investor starting out today compared to a decade ago?
Yeah, I think it's a really exciting time to be an investor, and particularly for those who are just starting out. If I compare to about 10 years ago, even 20 years ago, when I first started my career as an investor, there's a lot more options today. And these options include, of course, technology-enabled solutions and robo-advisors such as us and also other kind of, digital players out there. But also the invention of a lot of innovative products, for example, ETF, that enables very, very cost-effective ways to get access to some of the world's biggest industries and also indexes. Also, I think the improvement in technology has enabled much easier sharing and access of information. So I mean, just imagine that if you were doing some work on a company which just reported earnings about 10 years ago or even 20 years ago, I mean, the information about the earnings would not be so easily available on the internet. And I think back then, when I first started out, a lot of things were actually even done on fax. So today, I mean, we can easily go on to a LLM and ask the LLM to do analytics on company filings, company earnings, and also just kind of get easy access to investment advice through different digital platforms. So I think really technology has enabled a whole new era of investing, and that is very, very exciting. So I think for somebody who's just starting out, this is a great time for you to get more information and also to be able to develop the skill to actually filter out what is real useful information that would have impacts on markets and which ones are really noise. So for example, just take the, recent US presidential election. Of course, there's a lot of headline news, but I mean, what is actually going to just transpire into actual policies that get implemented in an upcoming administration, and which one of those are actually going to impact asset prices is very, very different from just reading a headline. So I think on one side, you have much more information, but on the other side, it's sort of like increased complexity of how to filter out the noise as well.
Yeah, I guess I completely agree with you. On one side, that there's so many options for us now to invest. It's a lot easier than ETFs. But on the other hand, with that, there is a lot of information out there. So it's kind of discerning what is noise and what is truly information that you need to invest. Which I think brings me to my second question. Since it's a lot easier for us to start investing today, it would be nice to hear from you about some of the core principles and steps that you take, when building a balanced portfolio. Say if you've got an initial $10,000 investment.
Yeah, so I think interestingly, I've talked about a lot of advancements in technology. But the principles of building a balanced portfolio hasn't changed that much. So again, it comes down to a few simple steps. Number one is to understand your risk. And here, what I mean by risk is that because when you invest in different asset classes, be it equities or bonds or gold or single companies, of course, the reason why you're getting extra returns on top of the risk-free rate is that you're taking certain type of risk. So first of all, you have to ask yourself, what kind of risk am I taking? So for example, if you invest in stocks, basically you're taking on the risk that the economic cycle would go up and down. A company may not actually deliver the earnings that you expect, or even some companies could go bust. So that's why there is kind of market volatility, and this is one of the risks that you're taking by investing in a public equity portfolio. And that's why you're given a higher reward for taking on that sort of risk. So the number one step to assembling or coming up with a portfolio is to ask yourself, what type of risk can I take? These can be measured in different ways. So for example, two kind of factors that contribute to the level of risk that you can take would be, number one, your time horizon. So for example, if you are still quite young, and let's say you're starting out in your 20s and you're planning for, say, for your retirement, you basically have a 40-year or even longer time frame. And for that pot of money that you are saving for your retirement, you probably can kind of put it away or stash it away and don't need to worry too much about ups and downs. So that allows you to take more risk with that pot of money. However, on the contrary, if let's say your savings is for a purchase that you plan to make in the next 2 years, that shorter time horizon means that you cannot take as much risk, because if there's a market sell-off, there's a shorter time frame for that investment to recover, and you have a certain cash flow need in the near term. So number one kind of factor to think about when you think about your risk appetite is your time horizon. The other factor to think about is your psychological acceptance of risk. Again, it's a very easy test. So one of the things that we like to ask our investors at StashAway to do is to think about drawdown risk. The drawdown risk is basically a percentage drawdown from peak to bottom. So for example, during COVID, there was a market sell-off, and the equities market actually sold off 30%. So the drawdown was actually 30%. Eventually, the market went back up, right? Eventually, markets recover all the losses and actually gain much more. However, surviving that 30% drawdown takes a lot of toll on your psychological pressure. And it's important that you ask yourself if you can kind of sleep at night or sustain through that 30% drawdown period. If your answer is no, then perhaps 30% is too much risk for you to take, because a lot of investors get shaking out at these market turmoils and market short-term drawdowns, and you don't reinvest again and miss out on the long-term gain. So it's important to be able to stay invested through some of these market drawdowns. And as we all know, market drawdowns actually is not, it happens, right? It happens every few years. So it's important to ask yourself, what sort of drawdown can you still stay invested? So I think those are the two things to think about in consideration for risk appetite. And that's the first important step in any portfolio construction.
Great. Thanks, Stephanie. I love how you started off the first core step is talking about risk, because, Warren Buffett's first rule for investing is not to lose money. So it's super important to kind of know what your risk appetite is. It's interesting because I'm thinking about people that I've spoken to who haven't yet started investing, and the thing that they say that, the safest investment is actually putting it in the bank. And then you speak to other types of investors, the more kind of risk takers, and they say, oh, let's just all go in US tech, Nvidia's done so well. So it's interesting, and leads me to my next question again, how can investors in today's market effectively balance this risk and reward that you're seeing today?
Yes, I think it's a great question, right? Because you mentioned about cash, you also mentioned about Nvidia. These are two very, very extreme examples of risk spectrum. And one other word that you mentioned is actually balanced. So it's actually a key word to think about and to focus on, because as investors, we can actually make returns from multiple sources, right? We don't have to make returns from one source. And also, as I mentioned, whenever there's return, there's a certain risk associated with it. Now, when we think about cash, I mean, this is what we call risk-free, because in most cases, I guess the government actually guarantees that you get that sort of return if you put the money in the bank. Now, that also means that because it's risk-free, it doesn't give you a lot of extra return. It only gives you what the inflation rate could be, and perhaps in today's environment, it yields slightly better than inflation, but that's it. And I think for long-term investors, a lot of people may have too much money in the bank because you think investments is actually risky. And I think, of course, if you think about just investing in single names like Nvidia, indeed, yes, it is very risky because everything, your return actually depends on one single company. And that company perhaps could be quite crowded. A lot of people are already in it. And
Mm.
also past performance. We've all heard the phrase that past performance do not represent future return. So, I mean, just investing in Nvidia because it's done well in the past 12 months is not a great reason. And at StashAway, what we help our clients to do, or we help people to do, is to build balanced, well-diversified global asset allocation portfolios. And the reason why we advocate this type of investing is because it puts you in the sweet spot of having the right risk level and reaping long-term return from having that right risk level. So, for example, if you invest in, I just mentioned, if you invest in cash today, you get about 4% of returns. Now, if you go a bit higher in the risk spectrum and you invest in credit, fixed income, or government bonds, I mean, you get slightly higher, right? Perhaps you get 6% or so annualized return on average. Now, when you go into equities, which is again higher risk, then you get sort of 9 to 12% return on average every year. So as you go up this risk curve, your annualized average return also goes up. Now, of course, I'm talking about asset class as well, because when we go into single companies, these kind of returns vary a lot more. And as individual investors, if we don't have a lot of time to look at individual companies, then I mean, it's best to stay at asset class levels, because even though, let's say, you may think that getting a single digit return on a balanced portfolio is not that, doesn't look that sexy, but if you compound that over time, if you compound that over 30 years, 40 years, it's actually very, very powerful. For example,
Mhm.
if you have a portfolio, balanced portfolio that yields 7% a year, in 10 years' time, that portfolio would have doubled. And in 20 years' time, the portfolio value would have gone up 4 times. And give it 10 more years, it would have gone up 8 times. So these are very, very powerful math that a lot of people forget, right? And it's not that difficult to get. You just need to have a balanced portfolio with the right risk level that helps you to stay invested throughout these different market conditions. And I think that's why coming from a asset allocation point of view is so important, and that is much more sustainable way to investing than either just staying in cash or just putting every dollar that you have into Nvidia, which perhaps you don't have a lot of expert information on.
Yeah.
So it's not too difficult, and everyone can start.
So true. Well said. I love the bit when you talked about the magic of investing, which is compounding, because that happens over a long time frame. It's not like betting. You're not speculating on something, then you
Yes,
make a big return in a year's
yes,
time. That's not investing.
yes,
And I guess to that point as well, a lot of investors sometimes they argue that what they have to start off investing is too small. Like, I'm not going to make a huge return with 1,000 or 10,000. I'm going to wait and save, until I have a more sizable investment portfolio.
yeah.
From where you're coming from, what common mistakes do you see new investors make with small portfolios, and how can they avoid them?
Yeah, I think you mentioned a very good point, right? I think one common mistake that most investor, or I shouldn't say mistake, but perhaps misconception, is that I have too little money, I can't start. Uh, and with technology, actually, everybody can start, right? For example, at StashAway, we actually don't have a minimum, we don't have a lockup,
Mm.
there's no subscription fee, so anybody can start investing with us for as little money as you like. So I think there's no excuse to not start. And the other misconception is that if you have a small starting capital, your return is not going to be great. Again, I think this is also a misconception because I talked about the power of compounding. And even though you are early, even though you're starting small, if you're early, you actually have time on your side. So we always think, like, I guess we all heard of the phrase "time is money." I think it's, of course, it's true that every one of us has a job and we go to work and we work time in exchange for our pay, our salary, that is money. But the other aspect of time is money, which is often missed by a lot of people, is that you need to give money enough time to
Mm.
work for you. And for a lot of our kind of audience here who are still young, you are actually very, very lucky because you have a lot more time. Versus like somebody who's in their 20s versus somebody in their 50s or 40s has 20-year ahead start, right? As I mentioned, the compounding effect makes a big, big difference when you have a much longer time horizon. So you give money the time to work for you. I think in terms of construction, portfolio construction, or kind of misconception, the other thing that a lot of people confuse about is the concept of trading versus investing. So I think there's an important distinction here. When I was early in my career, as I was actually working at Goldman Sachs as a trader. So I've been through the life of a trader, and I think I have some personal experience to share. What is the difference between the trading and investing? So a lot of people actually like to, I guess, think that they're investing, where in fact you're actually trading. And the difference is that in investing, you're trying to benefit from very, very long-term fundamental trends or fundamental reasons of why an investment should give you certain returns. So, for example, I mentioned if you invest in equities, on average, typically you would get 9 to 12% return on an annual basis. And the reason why equities is giving you a return is because equities is made up of companies, and companies actually grow earnings. So when companies grow earnings, I mean, this goes into the bottom line, goes to shareholders, and you as a shareholder actually enjoy that earnings growth. When you invest in fixed income, the reason why there's a coupon, there's a return, is that you lend money to somebody, and if somebody borrows money from you, they need to pay you a coupon. So these are very fundamental reasons of why you should have returns from these asset classes. So, I mean, investing is actually fairly simple when you understand these very, very basic concepts. And what you're trying to get from investing is these risks that you're taking, these things that like money that you are giving people in order for them to generate extra. In investing in trading is very different, right? In trading, you're trying to take advantage of market movements. You're trying to buy low, you're trying to sell high, and you're trying to beat everybody else in the market, because in order to buy low, sell high, you need to understand what other market participants are thinking, like what is the market sentiment, what is the great entry point, exit point, etc. So it's a lot more difficult. And if you are just kind of everyday investor, you may not have the skill, the resources, or the time to do it. And it's very, very frustrating sometimes too, right? Because you need to be watching the market all the time, and it's not that easy to get it right. I think if the other thing to distinguish between investing and trading is that investing should be quite boring. It should be actually very, very stable. And the best way to invest is actually not to do a lot, right? Is to, for example, we advocate our customers to set up dollar cost averaging. I mean, invest in a fixed amount every month when you get a paycheck, and then over time you let your money grow for you. Whereas in trading, you really need to be on top of markets, right? You need to know when you're going to enter, exit. Of course, it's a lot more exciting, but it's a bit akin to going to the casino, right? You get sort of entertainment, you get excitement out of it. But at the end of the day, is it going to help you to grow, like seriously grow your wealth over the long term? Not necessarily. So I think it's okay to have like a smaller part of your assets as trading, if you like the trading aspects of it, but keep it that way, right? Keep it very, very separated and focus on building your core investment portfolios, because that's the part that will actually make you much richer, much kind of financially capable in the long term.
Yeah. Just listening to what you said, I kind of wish I'd started investing in college, not, when I started working. So
actually, I did too.
The sooner you invest, the better it is. Coming on to my next question, we've talked about investors with small portfolios, and now, if let's say someone has taken your advice and started investing, and they have grown their pot, from $10,000 to $100,000 to, maybe even $1 million. How do strategies shift when you're talking about bigger sums of investments?
Yeah, I think the basics of building a portfolio, the fundamentals that I talked about, these don't change. However, I think what starts to change when you have a bigger part of bigger kind of pot of investments is that your investment options actually gets expanded. So, for example, if you're starting small, perhaps you're limited to buying public market equities, ETFs. Where you have a bigger kind of size portfolios, then you can start to invest in some fixed income instruments because these have minimum amounts. And then when you have even more, then you get access to private markets, alternatives, because then, for those assets, the minimum is a lot higher. For example, if you have to get into some of the private market investments, you need to have a minimum of, let's say, $1 million in terms of per investment. So these are not easily accessible by everyday investors. However, I would also say that technology has actually start to break that barrier and make it easier for everyone to start to access products that weren't accessible before. So I'll say, maybe I'll cite a few examples. So number one example is fractionalized trading. So for example, at StashAway, our technology allows our investors to buy into fractionalized shares of a particular ETF. So that way we enable the service of very, very low minimums. Secondly, if you look at the ETF market, that's also advancing very, very quickly, right? We've seen a lot of the kind of options-enabled ETFs emerging in the past few years. And these ETFs actually offer kind of retail investors the structured products that were only available to high net worth individuals a few years ago. And then lastly, I think if you look at private market products, they're not kind of into kind of mainstream ETF formats yet, but platforms like ours are actually making it a lot easier for people to start to invest in smaller ticket sizes. So what we do is that we aggregate our investor investments into bigger chunks, and then we allocate into these these harder to get alternative or private market funds. So, throughout these kind of different innovations and technologies, we actually make it easier for everybody to access the full suite of financial products, even with a smaller ticket size.
Great. Thanks, Stephanie. Unfortunately, our time for our discussion and my questions have come to an end because there is a whole lineup of questions from our audience here waiting to be answered. So let's move on to Q&A. I've got an interesting question from Alejandro, and he was particularly, I think, interested in the example you gave of, a young person having a long time horizon, so he can choose to take on more risk. He is thinking about, each bank have got, a target retirement kind of fund where the portfolio allocation changes as you hit your retirement age, the closer you get to retirement. So there are funds like that. But on the other hand, he also has a variety of options to choose from, like cryptocurrencies, different asset classes, stocks, bonds, and things like that. So I guess the general question is, how do you decide how to allocate your portfolio over time and think about portfolio allocation in general?
Yeah, so at StashAway, we do 2 layers of portfolio construction. Of course, we use a lot of systems and also data to help us to build these optimized portfolios. But maybe I'll just walk through kind of the frameworks and the general way that we do it. So to start with, we basically look at something called the strategic asset allocation. So I mentioned about the different risk levels. And so at StashAway, for example, we offer 12 different risk portfolios. And the way we construct these portfolios is to take the different asset classes, for example, bonds, equities, and within equities, US stocks, China stocks, etc., and run them through our optimization engine. So basically what we do is that we, for each of these different risk points, we put into the system the expected return and also the expected risk, and also the expected correlation of these different asset classes. And the system uses an algorithm, which is basically a mean variance optimization, to come up with an optimized portfolio that provides the best return based on a certain risk profile. So that's kind of the layer one, which is the strategic asset allocation part. And then secondly, on top of that, what we do is that, we actually change, or our system actually change its input in terms of the expected return, expected vol, and expected correlation based on where we are in the macroeconomic cycle. Because these metrics actually change throughout different cycles. For example, during a recession, equity risk is much higher than during a kind of growth period. At the same time, bond returns is actually higher in a recession than a growth period. So we take into account these different assumptions during different economic cycles and feed them into our engine. So this is something that we call the tactical asset allocation. Now, of course, we don't trade around. We don't adjust our portfolio kind of every day or not even every month. But when these important regime changes happens, which happens on average every 12 to 18 months, that's when we adjust our portfolio to account for these differences in terms of the macro environment. So I guess from a very, very top level, that's how we do it. Of course, the devil is in the detail. How do you come up with these assumptions? And then also how to detect regime change? I think those are, I would say, sort of the secret sauce that we have in our frameworks.
Yeah, yeah, and I guess it's important to know that when it comes to investing, you don't need to get it right or perfect the first time round. It's something that you learn over time, is I suppose that you're super familiar with.
Yes.
Yeah. Okay, so there are a couple of other questions here. There is a question asking about, whether having a disciplined mindset when approaching investing is a good approach. And someone's also asking, on the topic of discipline, when it comes to investing, should we wait for the share prices to drop, before we buy, in order to optimize our profits?
Yeah. So I think having a disciplined mindset, yes. In short, I think it is a essential kind of attribute to have as a successful investor. But also, I mean, discipline doesn't mean that you always have to wait for a dip to buy, right? Because it's almost impossible to accurately predict when the next dip is going to happen. And if the dip actually doesn't happen, in the meantime, your money is not working for you during that time. So remember, I said like time is money. If the dip actually doesn't come, like your money just kind of sit idle for that amount of period. So I think, I mean, to stay disciplined, we should actually be disciplined about our investing habits. So, for example, a lot of our best investors or our happiest investors actually have the habit of doing a dollar cost averaging, having like a regular deposit into the investment plans on a monthly basis, or some even do it on a weekly basis. But I think just having that sort of regularity of doing kind of periodic investing, that helps you to kind of weather through ups and downs, and also to ensure that you, stay invested over the long time. And I mean, it's not easy, right? I think a lot of times our psychology actually work against us. We always have this fear of, oh, am I buying at the all-time high? When I buy it, am I going to regret? There are a lot of tools that can help to overcome this. I mentioned dollar cost averaging. The other tool that we can use to overcome this mindset is chunking, right? Let's say you have like, let's say $100 in idle cash and you'd like to invest. You don't know if you're doing it like right by investing right now. What you can do is to split it into 2 chunks or even 3 chunks, right? Invest the first chunk today. And I mean, for the rest, I mean, you can either set a time frame or you can set like a level to invest the rest, right? The great thing about chunking is that I think one of the biggest fears for investors is the fear of regret. So you kind of try to minimize your chance of regret. And with chunking, you never regret, because let's say you invest $50 right now and the market goes up, you still enjoy that upside from the $50. And if the market goes down, then you can take advantage of that and deploy the rest of the $50. So either way, I mean, you would feel quite good about yourself and you wouldn't regret. So I think that's another kind of mental trick that I have advised people and myself have employed as well, that helps to overcome these kind of mental barriers.
Yeah. And yeah, you mentioned, I like the tool that you mentioned, with dollar cost averaging. And there are many platforms that kind of allow you to do so. So just, take the decision out of your hands, just do it on a regular basis so you don't have to think too much about it. The other tip I think I have, at least I think it works for me, is just not checking my investment portfolio too often. Because then it's like out of sight, out of mind. I've made my the investment decisions. I'm just going to let my money do the work, the markets do the work.
But also statistically, I mean, the less frequent you look at your portfolio, the more likely you're going to see it returning positively. So if you kind of look at the stats, over a 10-year time horizon, for example, equities have never returned negatively. However, as you shrink the time frame, let's say on a daily basis, equities actually have a negative return almost 50% of the time. So I mean, that's kind of your chance of seeing happy returns versus like non-happy returns. And the less frequent you look at it, the more likely you're going to be happier.
Yeah, agreed. Thank you so much, Stephanie. We have come to the end of our session. Thank you for sharing your investing wisdom with us today. It's very clear from today's session that building a strong portfolio is achievable for investors at every level, with any size of investment. And your advice on balancing risk versus optimizing returns have been super valuable. Thank you too to everyone who have joined us today and contributed such great questions. Before we wrap up, just a quick reminder to stay tuned to our next session, where we'll continue diving into top strategies for the year ahead. And as always, feel free to connect and keep the discussion going on social using #ModernInvestorSummit. Thank you all, and I'll see you at the next session in 15 minutes.